Welcome to Kitco News. I'm Niels Christensen. Markets are still trying to digest the Federal Reserve's monetary policy meeting from last week. Here to talk about the Federal Reserve 2-year forward guidance strategy is Peter Grosskopf, CEO of Sprott Inc. Thank you very much for joining us today, Peter.
Well, thanks for having me again, Niels.
Let's jump right into this. The Fed does not see itself moving off the zero bound range until after 2022. What are your thoughts on this? What does this mean for the gold price? What does this mean for the economic picture?
Well, we tend to take a holistic view of the Fed forecast, which is that prior to getting into the current COVID situation, debt levels around the world had built up to such a degree, including in the U.S., that we think that the central banks have no choice other than to anchor rates at zero for the foreseeable future. This is a long-term need for them now, as opposed to what most people think of now as still being an option to increase. We don't even think that's on the table.
You've actually never really thought that's on the table because just debt level and we've just seen it explode. So do you think it's only a matter of time before gold prices start to react to this? I mean, we have seen prices sort of caught in a range for the last 2 months or so. What do you think it needs to break out? Did you just people realize that, hey, you know what? Debt levels are going to go are unsustainable, and it just needs devalued currencies to get out of this?
Well, gold is always relative to many other markets, and I think what's happened in the last 2 months is that there's generally been a very large recovery in the publicly traded asset prices, both stocks and bonds. So in the environment where risk was going back on, gold looked relatively less attractive and therefore has been range bound. I think that the monetary backdrop of either negative or zero interest rates is going to exist for the long term now. I think people are getting more used to that, more comfortable with that. That's very supportive for gold. But in order for gold to move higher, it's such a massive market. It needs other markets to kind of cooperate with its thesis. And I think a correction in the equity markets would help that most of all right now.
So you mentioned equities. Let's look at equity markets for a second. I mean, we have seen this record rally, 40% rally off of the March lows. NASDAQ hit record highs. I've talked to some people about this, sort of the exuberance in equities. It doesn't feel safe to me. It doesn't feel like anybody's really learned anything in the crisis that we saw, 2 months, 3 months ago. What are your thoughts? I mean, is this sustainable? If the Fed is pedal to the metal for the next 2 years, do equities look good in a compressed risk environment?
Well, I don't want to be so altruistic as to give investors lessons in the equity market, but I would say this is a fully related to the 3 or 4 trillion of printing that's occurred and the money that needed to go somewhere. I mean, the Fed's been in the market buying bonds, and that's generally been the signal that the Fed put is alive and well, and you can go and buy risk assets. Personally, I don't buy the V-shaped recovery at all. I don't buy that we don't have much greater long-term problems here. So I would think that you should be very cautious with this equity market rally.
I know one of the things we talked about last time, you're saying, the Fed still has some ammunition with yield curve control, stuff like that. That's actually been gaining a lot of press now that we've seen yields push higher. I'm sort of wondering, what's your thoughts? I mean, is this the next stage for the Fed, do you think? Or have they done what's necessary with their forward guidance?
Well, I think to maintain that forward guidance, the Fed's tools need to be in full action. So we follow a few esteemed economic research houses that assure us that the Fed is going to need to be there in force in the Treasury markets. In fact, effectively nationalizing that market to purchase its own treasuries to keep yields in place. So we think yield curve control is a suitable acronym for what has to happen going forward, and we think it's a long-term management situation. If you go back to the Second World War era, the Treasury managed interest rates for almost a 10-year period.
So you're obviously bullish on gold. You see prices pushing to record highs above 2,000. What's the way to play this though? Do you like the bullion or do you like miners?
Well, we see bullion as a store of purchasing power, a store of value, an alternate currency, and a hedge. It's much more liquid than the miners. It should be at the core of everyone's portfolio. The miners are a more aggressive way to participate in gold. They're leveraged, usually 3 times the price movement to bullion. And we do think that the miners will have very strong earnings growth going forward, and also that the junior miners have lagged here and represent an incredible buying opportunity.
Last question then. You say, gold should be a core part of our asset. I'm sort of wondering, in this environment, everybody talks about, holding 5 to 10% of your gold. And I've asked this question to a number of people, sort of trying to find this consensus. Do you think people should, in this environment, should people be more overweight, say the 10% or maybe even above that in their portfolios? What do you think? Is there a magic number?
Well, we advise all our clients that 5 to 10% is appropriate and I think necessary considering what's going on in the macro backdrop. I'm much more comfortable than that. I'm probably 30% weighted. Eric Sprott would be 100% weighted. I think it's time to be quite aggressive with your bullion allocations, just given how much of a credit crisis we're really still in.
That's fantastic advice, Peter. Thank you very much for your time. This has been a fantastic conversation.
All right. Thank you, Niels.
Thank you for watching Kitco News. For the latest in the precious metals markets, go to kitco.com. Stay safe and stay healthy.